Good morning, dear students. Today we will learn about projects, project management, overview of capital budgeting, how the things work out when it comes to choose a project, a specific capital budgeting, and the types of investments and other issues while handling a project. So this course is basically especially meant for BBA professional students who are which is one of the premium courses what that we have at our institute. And we will start with the first chapter or the module one chapter, the chapter one, which will talk about overview of projects and what is a project and what are the different ways and importance and difficulties in implementing a project. So I'm sharing a screen right now. Okay, we'll start. All right. After, what are the objectives? We definitely have some objective, for any specific teaching pedagogy. So, what is the learning objective for this chapter? After studying this chapter, you should be able to appreciate the importance and difficulties rather than what we can say is pros and cons associated with capital investments or capital budgeting. Describe the broad phases of capital budgeting. What are the phases? What are the cycles of capital budgeting? Important facets of project analysis and rationale for maximizing the value of a firm, which is the ultimate goal of any firm, and understand the common shortcomings or weakness in capital budgeting. So, what is a project? A project, also referred to as capital expenditure or a capital investment or a capital project or just a simple project for any company that typically involves cash outlays or funds, what we talk about in a broader sense, and they will generate a stream of benefits. When you talk about benefits, we are talking about value, as in we are talking about generation of continuous cash flows into the future. So the project can be any expenditure which will yield a benefit in the future. Now, importance, we talk about importance, long-term effects. The scope of current activities of a firm is governed largely by capital expenditures made in the past. Likewise, current capital expenditure decisions provide the framework for future activities. Basically, any company which is operating currently and having a certain cash flows or a stream of cash flows is definitely governed by the investments which were made in the past. And likewise, the current capital expenditure, when we put in money into any investments, they will generate a future yield. Then we have irreversibility. We can't reverse the investments we made into a particular project. For example, if you want to invest into a new product, diversifying into a new product, we have to make sure that money which we are investing, if the product failed or if the things doesn't work out, the money cannot be recovered, right? So the project has irreversibility. So it is one of the typical features of project. Then we have substantial outlays. When we talk about substantial, it is quite impactful. So capital expenditure usually involve a very large amount of outlays. As in, when you talk about outlays, we are talking about cash flows going out. So a huge investment is required, whether you are investing into a brownfield strategy or a greenfield strategy or a new machinery, a new plant, labor, skilled technology, upgradation, training, continuous training, research and development. All these things will involve a huge amount of money. Then we have some difficulties. That was the importance of capital budgeting. We will talk about difficulties. What are the different difficulties while handling a project or capital investment? So first one is the measurement problem. So basically, when we talk about measurement, we are talking about identifying and measuring the costs and benefits. So CB ratio, what we also known as cost to benefit ratio, or profitability ratio in other terms, we call it. We will discuss about that later in the chapter. So measuring the cost to benefit ratio is quite difficult sometimes, especially in case of tangible and intangible assets. When you talk about intangible, we are talking about service, something which can only be, felt, some service, or, which is unlikely like a product, which you can feel and use it. Service is perishable, right? You can't take it away with you. So service is something like you can't touch it, or it is like an intangible thing, right? So measuring an intangible thing is quite, you know, a complex task, and it is almost impossible to measure the exact amount of, capital expenditure, as in cost and benefit ratio, in cases of intangible assets. Then we'll talk about uncertainty. uh, it is a difficult predict exactly what will happen in the future, since we study project management or capital budgeting, and we always take into consideration time value of money and discounting factor, because the future is unexpected. We don't know what will happen in the future and how our money will be valued in the future, whether it will go up or go down, whether the cycle in the economy will be boom or recession, it is in recession. So we don't know about that, right? So there is a huge amount of uncertainty, and hence it makes the, capital outlay investments, the initial investment, more risky, because we are not quite sure about the returns on our investment, whether it will go the same way which we have predicted. There is a great deal of uncertainty characterizing the CD ratio of a capital expenditure or a capital expenditure decision. And temporal spread, spread as in there's a huge spread since the time you invest into a project, and the benefit starts coming out after quite a long time, or they're spread over a very long period of secular period of time, like example 10 to 20 years, which will make it more difficult and cumbersome to calculate uh, you know the profitability of a project or a capital investment. Then we'll study about types of capital investments. What are the different types? uh, Based on simple level, if we call it as based on simplest level, if we say, then at the ground level, we will talk about physical assets first, then monetary assets, and then intangible assets as we talk, right? So intangible is just the opposite of physical assets. So we'll start with physical assets. Physical assets are tangible investments. Example, land, building, machinery and plant, and all other infrastructures and ancillary products like the delivery vehicle, the supply chain vehicles, computers, consoles, etc. These are all under physical assets. Then we have monetary assets. Monetary assets are basically, we are talking about financial assets or financial claims against some instruments for parties, like deposits, bonds, equity shares, etc. Then we have intangible assets. Intangible assets are not in the form of physical assets or financial claims. They are rather, they are like some extra thing which is, done in the form of training, recruitment, research and development, market development, franchisee fees and all that are expected to generate, benefits over a period of time, but they cannot tell you the right amount of BCR or benefit to cost ratio within the stipulated period of time. They will not just tell you. It is quite difficult to measure the intangible assets benefit on the investments. Then we have, we'll continue with the types of capital investments based on corporate. That was on the ground level. And if you talk about corporate level, we are talking about two things: strategic investments and tactical investments. So strategic investment is made by the management at the top level, and it is for a longer period of time, whereas tactical investments is made at the operational level and it is for a shorter duration. Then we have again types of capital investments continued. Strategic investments, if you talk about a strategic investment, is one that has a significant impact on the direction of the firm. Example is given, a very a relevant example is given. Tata Motors' decision to invest a passenger car project may be regarded as a strategic investment. Opening or starting a 1 lakh rupees car like Nano was a strategic investment, and again dumping it on the, as per the economic scenario or consumerism or purchasing power of the consumers, dumping the idea of or stopping the manufacturing of Nano was again a strategic decision. And making or to make or and turning that money to some other investments after being stopping the investments into the Tata Nano, and diversifying the investment or transferring the investment to some other profitable goods. Then we have tactical investments. A tactical investment is meant to implement a current strategy as efficiently or as profitably as possible. Very short period of time, day-to-day tactics we allow or we approve in a management or at the operational level or the middle management level. We have different tactical investments to reap some a temporary benefit out of that. So example again, to investment by Tata Motors replace an old machine to improve productivity. That's again fall under the tactical investment, to remove old and obsolete technology with a new one. For example, just a machine, not a whole plant or a field or a factory. We're not talking about that. We're just talking about a old machine replacing with a new one. That will come under the tactical investment. Then we have different types of capital investments, and based on the different companies, we have different investment like mandatory investments. Then we have replacement investments, expansion investments, mandatory investments, like a replacement investment, expansion, diversification, research and development, and miscellaneous investments. We will take one by one all the six types of capital investments. So let's talk about mandatory investments. Mandatory investment is a capital expenditure required to comply with statutory requirements, something which cannot be avoided. It has to be there. For example, if you want to open a liquor industry, you need to take a license from the central excise. So that is something which is mandatory or statutory. You have to have it. Without that, you cannot start. You can't open a petrol pump without a license from the government, right? So these are something which is like you have to do it in medical field, in something to relate with the socio-ecological factors. And also example which we are given is pollution control equipment, pest control equipments, firefighting equipments, medical dispensary. For example, if you want to open a pharma, you need to have a basic license to open a pharma agency. So these are the mandatory requirements or investment which you have to make it. Otherwise, you can't open or kickstart the business. So again, the next one is replacement investments. So as the name suggests, it is meant to replace any obsolete or teared out machinery or equipment with a new one. The reason why the replacement investment is done as to reduce the operating cost, maybe because the old machine is is too much cost consuming. It is not giving the optimum output. Second point, obviously increasing the yield. New machinery will definitely help in increase of production and output and volume. And definitely the third point, which will lead to increase in quality. Manufacturing quality will be much better than the old machine as the time move forward. Then we have the third type, as the name suggests, again, expansion investment. And expansion investment is meant to increase the capacity to cater a growing demand. For example, if you have a product for which the demand is increasing day by day, or something has happened in the economy, there's some change in the taste of consumers, and something happened due to which the demand suddenly rises. For example, currently pandemic situations, what is more necessary now? The demand for sanitizers, hand gloves, masks are increasing manyfold. They are growing day by day. So now what happened? The companies already making it. The medical companies like Reckitt and Benkinser, the Hindustan Unilever, and all the companies, the medical companies, pharma companies, different pharma companies which are making these things have to step up, and expand the current output. They have to increase the production. They have to increase the yield as of now. So they have to, invest a lot in the expansion. So that is the one classical right now. The situational based example is this only, right? Then we have diversification investments. As in diversification means, entering into a new market or new product or new service. A company making a cycle wants to move into a moped business, or rather not moped. Let's talk about a two-wheeler, a scooty type of two-wheeler. The company wants to move into. So what will happen? That's a sort of diversification, and it aims at producing new products or services, entering into a new geographical areas. It might happen as that if we're not just talking about products, we may also talk about the area where which it was operating. Now it wants to operate into different areas as well, where the things have never been sold. So all these types of movements from the pre-established territory into a new territory or into a new product or service will come under diversification investments. Then we have R&D investments, or research and development investment. It is one of the cost for the company. It is an investment which, for the benefit which can't be yielded in terms of measured in terms of money, but definitely yes, the more a company invests in research and development, especially the technology company, the pharmaceutical industry, the technology industry, and automobiles and all, or the gadget, the mobile phones, all these industry who invest a lot of money into research and development will have a better product, and they have a competition, they have an edge over the competition, in the competition over their competitors, when they invest a lot of money and manpower into the research and development, so which will sharpen the technological edge of the firm. And then we have miscellaneous investments. The miscellaneous investments represent catch. I mean, catch here is as in all category items, like anything, something like overheads, what you talk in accounting, when you talk about accounting, anything which comes under, apart from all these, will fall under this category. The example which we have given is interior decoration, the money. For example, if you talk about, let's take Tata Hotel, I mean, Indian Hotels Company, which is owned by Tata's, the Taj Hotel, right? For example, if you want to, modify or renovate their rooms, into new things like in-room check-ins, not the keys, cards and all, replacing the magnetic card readers, replacing the keys, the in-room check-in, guest facility and all that. If they want to invest into that, decoration of the room should be changed, wooden floorings and all that, the TVs and all that, the sofas, the mini bars and all. If they want to change it, all these investment will come under this miscellaneous investment. Recreational facilities and landscape garden, these are all few of the facilities where the company or firm give to their employees to provide them a happy environment. Then we have phases of capital budgeting. We have, six phases of capital budgeting. This is a very, a simple flow chart which is self-explanatory. Number one is planning. Obviously, you have to plan what, where, and how much you have to invest. Then analysis. Analysis as in, checking the different techniques, how to, invest into it, and what will be the return. So analyzing. Then we have selecting. We have different methods for capital budgeting, and we choose one over the other depending on the situation. Then comes the financing. Once the method is chosen, here comes the financing. Financing as in the capital coming out from the shareholders, coming out from raising of funds through debt or through equity shares or the retained earnings. Then the implementation of the investment and the strategy, and finally reviewing or keeping a check on the progress of the investment. Let's take a short look at each one of them. Planning. The planning phases involve investment strategy and the generation and preliminary screening of project proposal. We make a decision when there are different types of proposal. We make a decision and we have to choose the finest one. As in, when we say finest, we're talking about optimum. right? So there'll always be an opportunity cost attached to it, but definitely, yes, we have to make sure that we are choosing the optimum proposal. The investment strategy provides the framework that shape, guides, and circumscribes the identification of individual project opportunities. It will, it will provide a whole guideline as to what will be the different option and what has to be chosen as per the objective of the firm. It is very important. What is the objective of the firm in the long run? Then we have analysis. Obviously, analysis means if the screening, after the screening stage, the project is worth investing. Now we haven't done the investment. The analysis part comes in, and we have to study a whole detailed analysis of the marketing, technical, financial, economic, and ecological aspect of the project. Selection. The selection process addresses the question, is the project worth investing? Selection as in comes in whether we, after doing all the analysis, is the project which we are investing right now is worth it? As in, would the benefit will out, will out the risk associated or the investments which we have done. So the selection process addresses the question, is the project worth investing? A wide range of appraisal criteria has been suggested to judge the worth of the project. Basically, there are two criteria which we judge on the basis of selection. One is discounting, and second is non-discounting. So, what is the difference? There are few methods as listed at below. Discounting methods consider into time value of money, while as non-discounting techniques doesn't consider the time value of money. So the accept and reject area, as well as the some of the criteria we'll talk about. First, talk about non-discounting. The non-discounting means the methods which does not include uh, you know the uh, the time value of money, as in no discounting. No discount factor is associated. So first one is payback period. Within how much time the money initial amount is refund comes back into the business. It's a very simple thing. It's a very common calculation. And accept ranges. The payback period should be less than the target period, and reject if it is more than the target. For example, I have invested into a business, and my target period is 4 years. If the payback comes with before 4 years, the project is accepted, otherwise it is rejected. Then we have ARR, accounting rate of return, also known as average rate of return, should be greater than target rate, then it has to be accepted, otherwise it has to be rejected. Then we have some main criteria. Discounting, the most common ones which we consider, that is net present value. And the range and the criteria is obviously the net present value is the amount of cash flow discounted over a period of years through the current discount rate. And if it is greater than zero, we will accept the project. And if it is less than zero or negative value, then we will reject the investment. Same goes for internal rate of return. Internal rate of return is, one of the point where the cost of capital, the company's cost of capital should, it should be more than cost of capital. Then the internal rate of return is accepted. The method of internal rate of return is accepted if it is more than cost of capital. And then the last one, which we're talking about, BCR, or benefit to cost ratio, also known as profitability ratio. It's just the ratio of the total cash flows divided by the incoming, the total cash flow incoming divided by the initial investment. So it is a ratio, and it is only accepted when it is more than 1. If it is more than 1, that means the numerator is greater than the denominator, and hence we will accept the project. Let's move to next, another phase of capital budgeting, which is financing. After selecting the project, depending on which investment criteria we have chosen, we have to make the financial financing. The suitable financing has to be, two broad sources of finance are equity and debt. So let's talk about flexibility, risk, income control, taxes, the key business consideration that influence the capital structure decision, and the choice of specific instruments of financing. Basically, when you talk about debt, it is like taking a loan from a bank or issuing bonds. When you talk about equity, you're talking about issuance of equity shares in the company. So all those things, flexibility of capital structure, leveraging of capital structure, risk, how much risk is associated with both the investment types, what are the income coming out from that, how much debt will interest you have to pay out of a debt, all these things have to be considered. You have to check the whole capital structure through these two methods of financing. Then we have implementation. When you talk about implementation, the implementation phase for an industrial project, which involves the setting up of manufacturing facilities, consists of several stages. Implementation is more has to do with operations management. We'll talk about project and engineering design, negotiations and contracting, construction, training, plant commissioning. You have to choose a suitable manufacturing facility where all the things can be implemented. If you have already have one, then it's fine. Otherwise, you have to make a new one. Either you can go through a greenfield strategy or a brownfield strategy. And review is definitely one of the most important factor, because when the project is commissioned, a review phase has to be set in motion. Without the quality checks and performance review, the things will not come out as desired. So performance review should be done periodically to compare the actual performance with the projected performance. In this stage, feedback is useful in several ways. uh, Number one, it focuses on realistic assumptions. What are the things coming in now will be realistic. It is not on copy and paper. It provides experience which will be valuable in future decision making, while taking the feedback, or contingency plan, while attending the contingency plan. The experience will be real. It will help in future decision making. It will definitely suggest the corrective measures and actions to be taken at then on a real time basis. It helps to uncover judgmental biases, the decisions which were biased earlier, out of something, the past history or anything like that, will be corrected here once we are on the feedback mode or review mode. And it advocates the need for caution among project sponsor. How much money is coming from a sponsor, and what are the utilities coming in from another sponsor, and how much we are able to return to our sponsor. And same goes for sponsors also, where to and how to invest money. Then we have different levels of decision making, three decision levels: operating, administrative, and strategic. Basically, I've told you, the first level is operational level, then again the middle management level, and then the senior more top level is strategic capital budgeting. So let's talk about operating capital budgeting. This may include routine minor expenditures, day-to-day expenditures such as office equipments, um, replacing a small machinery like a printer on a day-to-day basis, on a monthly basis, weekly basis. That's all covered under operating capital budget or budgeting. The lower or the middle level management can easily handle the operating capital budgeting decisions. Then becomes the administrative capital budgeting. This involves medium-sized investments such as expenditure on expansion or existing line of business. And these are semi-structured in nature. These are not highly structured, unlike the strategic one. As they may also involve some options, such as options to delay. Generally, the senior management is assigned the responsibility of handling decisions. The middle management, the level of senior manager, vice president, or assistant vice president, are the ones who look or oversee into this administrative capital budgeting. For example, opening up a new line, opening up a new, an office, an extension office or extension line to a existing business. Then we have a strategic capital budgeting. This involves large investments such as acquisition of a new business or expansion in new line of business. And strategic investments are unique and unstructured and involve simple or complex options, as they cast a significant influence on the direction and value of the business. Top management generally handle this. Obviously, these are the decisions which are made at the top level, and these budgets involves a huge outlay of money, and hence they are chosen very carefully because they cannot be reversed, as we have already studied in the irreversibility features of capital budgeting. And then, keeping the view of the different decision making levels, capital expenditures could be classified in a way which would reflect the appropriate managerial refers to be placed in controlling. For example, if it is a simple level, it's on a day-to-day basis, or or a monthly expenditure, it can be done through operating capital budgeting. Then something which requires a substantial amount of money will be under the administrative capital budgeting, and something which is like a game changer altogether will be handled by the strategic management level. This is a common table which will help you to understand and classify levels of decision making. Like these are three levels: operating, administrative, and strategic. And where is the decision taken? First one is lower management, then we have middle management, then we have top level management. And how structured is the decision? Routine, semi-structured and unstructured. Routine as in, it is like a day-to-day basis. Every in 1 month, our toner will get down, our printer will go down. So we have to replace the toner every 1 month. We know that about that. So that's a routine maintenance and routine decisions. Administrative is more of a semi-structured. For example, there's a change in the environment or change in the demand of a consumer. Suddenly we want to make any changes to extend our current office or branch or anything like that, to explore the business, to increase the yield, to increase the volume of the business. So that will come under administrative. And strategic decision will always be unstructured, because it will be taken for a very longer period of time, for a very secular time, and it will be unstructured in its nature. It can be anything. It is not pre-assumptive. It is not pre-recorded. It can be anything depending on the futuristic options and returns. And then how is the level of resource commitment? Minor resource, obviously the operating decision will have a minor resource commitment. Financially as well. And then we have administrative decisions, which is a moderate resource commitment. It will require some amount of funds, definitely a huge amount of funds. And the last one, strategic decision, will require a very huge outlay of money, because it is for a future, change in the business, the futuristic, the business operating levels, or it will work on the new schemes and new things which will happen in the business on a next few years, or next 10 years or 5 years or whatever. And again, that will talk about the time horizon. The operating decision will have a short term, definitely yes. And administrative decision will have a medium term. It will impact the business for about a year or two. And then we have a strategic decision, which will be for a very long period of time, which will help the business to grow and expand, increase the market share and all, for a very longer period of time. Then there are some issues in investment story. Management must be convinced that the story, the firm enjoys a comparative advantage from the investment. This is basically, you have to prove that, there's no, everything is rational. The decision is rational, based out on different capital budgeting techniques. There's nothing assumptive. It has to be a rational decision. Then there are risk. The firm must carefully assess the risk associated with the project and ability to handle the same. There are a lot of risk involved while operating into a new investment. So all the risk must be assessed before making an investment. Then we have discounted cash flows value. The criteria like NPV, IRR are commonly employed because of the reason they take into consideration the DCF, or the discounted cash flows. The criteria of NPV and IRR are most common and used in the industry to assess the investment decisions. Then the financing mix should also be considered, as in I've told you about the leveraging, how much equity and how much debt should be in the capital, or overall equity or overall debt. That will decide the investment outcome of the business. The profitability of the business will be decided out of that, because the leveraging is very important when it comes to the capital structure. Then impact on short-term earning per share. Definitely investors and equity analysts consider EPS as a key indicator. When you talk about value of the firm, we talk in terms of EPS. So the incentive compensation of managers is often linked to some measures like EPS, or profit after tax. So definitely, when all these performance measures are linked with profit after tax or earning per share, it has to have an impact on the shorter term EPS as well, because the longer term EPS cannot be calculated for the shorter period of review or investment decisions. Then again, there are a few options. Capital project The options embedded in the capital projects are the option to delay, hold, change, expand, and the value and the option to contract or abandon the project. So these options are valuable because they will provide flexibility to the manager. It cannot be rigid. It cannot be too rigid that if it has been started, it has to be over and all. The investment may have gone, but you can choose to hold the investment initially and start it with the investments a few months or a few weeks later if there's any hold or change in the plan of the business. Then there are different facets of project analysis like market, technical, financial, economic, ecological. They will tell you about what are the different facets of market, like potential market, and the market share will tell you about the market analysis will deal with that. Technical analysis will deal with the technical feasibility and choices of the equipments. Financial analysis definitely will talk about risk and return. What are the investment risk and what are the returns? Then we have economic analysis. What will the benefits and costs? What is the benefit to cost ratio? What is the profitability ratio? How much you are investing and how much you are getting back? Other, in fact, economical impact on the business and definitely on the firm. And then the ecological, which will deal about the nature, the environment, environmental damage, and restoration measures to the environment will be dealt by ecological analysis. So this is something which is described in details, what I have told you already. And then this is the schematic diagram, or this is the phases of capital budgeting. You can see that generation of idea, then we have initial screening. If the idea prima facie promising, yes. If it is yes, then we will go ahead. No, then terminate. If it is promising, then we will plan the feasibility analysis, which will include the market analysis, technical analysis, tests, marketing, conducting, financial analysis. Then moving ahead to economical and ecological analysis. If the project is worthwhile, we will prepare the funding proposal. If no, then we will terminate the project. Then we have some objectives of capital budgeting, and then we have some weakness of capital budgeting. We will talk about that in our next lecture. Thank you.